Hi, everyone. Welcome to the Pineapple Realtor Education Series. We're going to give everyone a minute or two to get into the session. I'm still getting people registering for the session right now, so we'll just let people get in and then we'll get started in a minute. Okay, I think we're going to get started. Doing okay? Good. So welcome back to the Realtor Education Series. It's something that we want every month to get our mortgage agents and realtor partners up to speed on new industry stats and information up to date on the market and what's going on. And we took a break over the summer, but we're back with Kiki from Sagen, and we're really excited to have her here today.
Thanks for having me.
Yeah, you're welcome. Thank you. Before I get started, I want to let you know that Val is going to be our Director of Training, Learning and Development. Is going to be taking questions. So if you're online, put your questions in the Q&A section, and Mel will actually let us know when they're in there. And if you're in the room here, just raise your hand and we'll answer the questions. And then there'll be a Q&A session at the end as well. So it's up to you if you want to do it in the middle or free flowing it. Is that better? Thank you, Jamie. Kiki is the Vice President of Business Development for Sagen, and is responsible for building relationships with lenders, the real estate and building communities in Canada. And today's topic is understanding key trends in first-time home buyer motivations and their financial preparedness to buy their first home. Welcome, Kiki.
Thank you.
To get us, thank you. Good to get us started. Can you let us know who Sagen is and how Sagen is influential in the Canadian real estate market?
Sure. I've been with Sagen for 20 years, so it's an easy question to answer. It's certainly a pleasure to be here, everyone. And I expect that most of the mortgage agents will be familiar with Sagen, and my hope is many of the realtor partners on the call. But we are a mortgage default insurer, and what that means is anyone buying with less than a 20% down payment will require mortgage default insurance here in Canada. There's 3 players, and today Sagen is the #1 mortgage insurer in the country.
Oh,
yeah. So the lender will select the mortgage default insurer, and certainly as real estate agents and mortgage agents, you can influence where that insurance is placed. But that, in fact, is how mortgage default insurance works. And you might be familiar with us as Genworth. During the pandemic, we actually had a ownership change, and we are now 100% Canadian owned, and it provided us the opportunity to rethink our name.
That's awesome.
And so we are now known as Sagen.
Awesome. One of the other things is that affordability is a really hot topic for first-time buyers in Canada. What role does mortgage insurance like Sagen actually play in that affordability?
Yeah, I mean, I think the reality is affordability is a challenge for everyone in Canada, but particularly first-time home buyers who are really looking to get on that home buying ladder and begin to develop equity in their property. And the role that mortgage default insurers play really is that enablement of getting into a home sooner, because as house prices are rising, so too is the amount of down payment that you need. And so with the ability to buy with a 5% down payment, that really does enable folks to get into the market sooner than they would if they had to wait and save for a 20% down.
Awesome. Great. Without any further ado, let's get started into your presentation.
Okay. So what I'll take you through today, because we are so focused on the first-time home buyer, because the majority of folks buying a home are likely with a 5% down payment, first-time or move-up buyers, we spend a lot of time trying to understand what are their motivations, how prepared are they for this transaction. And we have for the last number of years worked with Environics to do a third-party survey of all Canadians, but then segmented by first-time home buyers, and I'll move to the next stage, first-time home buyers as well as first-time intenders. And so the survey work that I'll share with you today really focuses on those three segments: general population, first-time home buyers, and first-time intenders. First-time home buyers would be folks that have bought in the most recent 24 months. First-time intenders are those that anticipate purchasing in the next 24 months. And general population would be a mix of everyone else, whether they are mortgage holders today, own without a mortgage, are renters, what have you. And we've tried to conduct this survey right across the country, sampling for major municipal areas as well as smaller markets, but to get a really good representation of the Canadian marketplace. And also at the same time be statistically significant. So we did this survey work in March, released the results in May, and not unlike you, took a bit of a break over the summer when a lot of folks aren't doing lots of learning or doing lots of vacationing. So the survey, certainly it had some airtime before the summer, and now we're wanting to certainly make these segments, mortgage agents, real estate agents, the building segment as well, aware of what the results say, because it sets you up to have good conversations with your prospective mortgage holders or home buyers, so that you can anticipate what they're concerned about and give them the best experience possible.
That's great. There's been a lot of ongoing shift in the Canadian real estate market, even since the spring, with a couple of, the rate increase in July. They obviously held in September. Do you think consumer sentiment remains pretty much the same since it launched?
We do think that, and I appreciate the question, because sometimes folks will say, well, the work was done in March. Is it still relevant?
Right.
And we've gone back to Environics to really ask that question. And they are quite confident that the results are likely very similar today, because in March, when we did the survey work, the people that we were surveying had already felt some rate increases in an inflationary environment. And as I take you through the results, it's likely no surprise that they're feeling a little apprehensive. We think it really hasn't changed, because we had a bit of a flattening of rates, but then we've had a couple more increases since March. So we believe that that same kind of uncertainty and waiting to see what happens next is still relevant in the results that we'll share today.
That's good news.
Yeah. So maybe we'll get right into it. So first we'll talk about financial fitness. So we've asked two sets of questions, one around financial fitness and one about motivations and behavioral style questions. Financial fitness is not consumer confidence. It rather is asking, what are your attitudes about your financial readiness? What are you thinking about your long-term financial health? And we do that in conjunction with Environics, as well as the Canadian Credit Counseling Association here in Canada. And we started this work in 2011, set the base at 100. And since then have been tracking how Canadians are feeling about their financial situation, if you will. You can see in 2012, it dropped just a little bit, but then steadily increased ever since. And we saw a bit of a blip down, that 98.5 that you see. And if you have a look at the time frame, it's May of 2020. Well, I think we can all remember what happened just before May of 2020. So in March, when we're typically in market doing research, just before COVID hit, the research was done. People were feeling better than they ever had about their financial situation. By the time Environics does their analysis and we're ready to release in May came and we thought it really isn't prudent to go out to market and say Canadians are feeling better than they ever have about their financial circumstance, because this really, really impactful event happened. And so they went back in market and did another pulse survey, and results dropped, but not nearly as materially as you would think. And I think it is because things don't change that fast by way of the way people feel about their finances. And in May, there was still, while there was uncertainty, I think we felt like it wasn't going to be a 2-3 year long event,
Exactly.
right? We remember it was going to be a couple months maybe. So what happened though, when we went back in market in March the next year, it came up again higher than it's ever been. And that there are a number of factors around. You will remember that there were CERB payments for people who were impacted by the pandemic. For the most part, if people were homeowners, they tended to be the population that didn't see their jobs impacted. Where we saw income disruption was more in service-related roles, and not to say that homeowners don't have those roles, but more than not, those are renters. And so we saw homeowners less impacted by the unemployment that was experienced. And if you weren't experiencing job loss, you were actually experiencing stronger than ever savings, because you couldn't travel. There was online shopping, but you couldn't shop or go out to dinner the way that we used to be able to. And so there was this incredible through COVID period where Canadians were saving well beyond normal rates, if you will. So in May 2021, people were feeling incredible about their financial position by and large. And certainly if you're a homeowner, you were feeling great because house prices had really started to rise dramatically. And so you had a lot of embedded equity. Your house was worth more. What these results show that you can see on the screen is when we break out general population, first-time home buyers always overshoot general population. And we think that is because they are in the recent period really in savings mode, whether it's COVID or not, right? They're getting ready for the transaction, first time they're buying a house, so they're saving, they're changing their monthly spend patterns, and so they're really feeling good about their financial position. They're also likely having bought because they believe in equity building in their home ownership and their financial planning journey, and so they're feeling excellent because they've just bought a house. The green dot is the first time intender. They are feeling about where general population is, and that we think is really a positive sign that first-time intenders are feeling as good about their financial strength as the general population, because they're likely younger, so they're not nearly as, forward along on their income earning path as the general population. Some folks in the general population are homeowners. They already have embedded equity. So the fact that this intender group is feeling as confident really underscores their readiness for the transaction and their belief in this equity building and financial growth trajectory that this next phase is going to bring for them. So let's see what happened most recently. Not surprising, when we were in market in March, we saw it come down a little bit for the general population. So let's remember what happened in March of this year versus March of the year before. March the year before, we hadn't yet started to see rate increases dramatically. Inflation wasn't, growing and in the media every single day.
Exactly.
And when we saw March this year, people had experienced multiple interest rate hikes, so that was impacting mortgage rates, but it was also impacting loans, credit, every kind of mechanism that you would need that's attached to an interest rate. Things were getting more expensive.
Yes.
So people, rightfully so, were feeling a little more cautious about their financial position. We saw first-time buyers come down at a more dramatic rate than general population. And we really believe this is because for those that had recently purchased, all of a sudden they've got this mortgage payment and there's inflation that's billowing on top of their monthly obligations. And they had started to demonstrate some concern, for sure. They weren't falling down on payments, but they were demonstrating in this, they were more concerned about their short-term financial situation. First-time intenders, pretty steady Eddie group. They haven't bought yet. They're still planning, and they absolutely see the value of home ownership. So their rate really didn't change at all.
Good. Good.
On our website, you'll actually be able to get an infographic of all these key results, and It's at it's at sagen.ca, where our financial fitness results are found. This is a snapshot of the infographic, so you can see the chart I just showed you, but generally what this highlights is some of what I've been talking about. This home buying intending group, they're feeling pretty good, 36 or 31%, and then 44% of intenders are feeling like their financial position had actually improved in the last 12 months. And even more of them think it's going to improve more in the next 12 months, because there is this feeling that rates are going to stabilize. Now, since March, we have seen a couple more rate increases, but we're hoping we're nearing the end of that and you'll see some stabilization. You know, I was actually just last week at a conference where there were 3 economists from Canadian banks, and there's 50-50 chance they think the Bank of Canada may raise rates one more time by a quarter point, but 50% chance we're done. And I think after this, we're probably going to see an end to that. So that's not my opinion. That's the economists.
Just for everyone here, we've actually put a link to this in the follow-up email. So if you've registered for the webinar, you'll get a thank you email tomorrow, and a link to this infographic will be in that email.
And so what some of the results do show is, while they're feeling really good long term, there is this feeling of a bit of a crunch in the short term about managing monthly payments. Very few people are in what Environics and the Credit Counseling Association would deem as an alert situation. Only 4% of first-time buyers and 7% of intenders. So what it really does underscore, particularly for this group, is these intenders, we're going to see them come back to the market and they're ready for the transaction. So we've talked about this. Long-term confidence remains high in both of those segments, but it's the making the ends meet month to month where there's this little bit of concern. But Environics would really highlight here, the concern is not that they're making ends meet. The concern is maybe I won't be able to. So they've not fallen down on their monthly obligations, but it is this heightened awareness that it's a challenge. The good news is, and this again underscores the importance of home ownership to these two segments, when we ask first-time home buyers, would these economic circumstances have changed your mind if you knew they were coming? Most of them say no. They would have still bought a house. Okay. The intenders are saying, it's probably going to keep me on the sideline for a little bit longer. I'm going to wait just a little bit more time. So the definition of the intender group is the next 12 to 24 months. So 0 to 24, really. We kind of think what this is telling us, with 43% of them saying, yes, it might delay my decision a little bit. It might mean that there's a pause, and we're feeling it in the market right now, aren't we? This slowdown, if you will, but they're coming back is what this is telling us. So let's look a little bit more at some of the other things that are happening and include the general population in these next pieces of data. The general population really still thinks it's not a great time to buy. And you can see this data shows back to 2020 that this segment of the yellow and the red and the gray, which is the I don't know, it's growing as a percentage of the group that's thinking in the general population, it's not a great time to buy. There's still a small group that thinks that it is. But if you compare it to the intenders and the recent buyers, while they are certainly a good population that thinks it's not a great time to buy because rates have gone up, there are fewer of them that feel that way. And in March, we were starting to see the market cool a bit. We were starting to see fewer multiple offer situations in many cities across the country. So that really does kind of play into why this group who's been active in the market and looking at being active in the market, we're feeling more so like it's not a great time to buy, but not nearly as bad as the general population thought that it was. Supply is something that we hear a lot of talk about. And I think most people in the mortgage and real estate space would agree that house price appreciation is really driven primarily by supply. People less close to the economic details of it all would be general population and the general consumer that's buying. Interesting that fewer people think there's too little supply this year than they did last year. In part, it's because they're not seeing as many multiple offer situations. I think the reality is with immigration targets where we know they are, there really is a supply issue, that it's good news now that the governments at all three levels are recognizing. That doesn't mean it's all fixed, but it at least means that there's recognition that we can't just talk about it anymore. We've got to find ways to action it. Otherwise, regardless of what you do, there's going to be pressure on home prices if there's more population and fewer properties. You've got a question here. Yeah, you want to go back?
Which I find that ironic, considering the demographic that's most likely to cut interest rates from their affordability perspective. So what is it that gives them confidence? Because in the immediate term, they're the ones who are least able to work.
Yeah, so they're in savings mode right now, and they view home ownership as a vehicle to begin their path to real financial wealth enhancement. They've also seen multiple offer scenarios come down. They've also seen house prices come down a little bit from a year ago. So without being sophisticated the way a lot of us are and close to all the economic factors, they've seen, hey, I'm saving. House prices are coming off a little bit. We think interest rates are going to remain flat. And there's fewer multiple offers. That must mean it's not that bad a time to buy. Better than, let's say, a year ago when there were tons of multiple offer situations. And it was in the news every single day that it was a real challenge to find a house to buy, and there were all of these bidding wars. So we think that's what's driving some of their optimism. No, if they're intenders, they have not yet taken action, but they're telling us in the survey, I'm going to buy in the next 24 months. Yeah. Yeah. So that kind of gives us confidence as mortgage professionals, but also real estate professionals, that there is this segment that's preparing for the transaction, they're saving, and they're coming to market. So we talked a little bit about this supply situation already. Here's what we're thinking, and this will sort of build on your question about when these intenders are coming to market. Forward intention for people who own a house today and are thinking about buying, if we look back to 2019, there's been fewer and fewer of them that are saying, yeah, I'm going to jump back in the market and move up. If we look at non-owners who are going to buy a house, so that's the intender group, they're not on a full decline over the last several years. But in 2023, there's fewer of them that are saying, yes, I'm going to jump in the market soon. So I told you there's likely this delay, so maybe 6 to 24 months for these intenders. Even more of them, when we ask the questions, how about beyond 24 months in both categories? So people who currently own a house and want to make another move, and people who don't own that are going to come in after 24 months, there's a big group of them that are believing that by then there'll be a real stabilization in rates and it'll be a much better time to buy. So it's coming. We're feeling a bit of a lull right now, but it's coming.
And you said you've been doing this survey since 2012?
We've been doing the financial fitness since 2012, and really the homeowner motivations since around that time as well. Yeah.
Those stats of 24 months or longer, that's definitely a bit of change since like the last time.
Yeah. So if we look, here's the change from 2019, but it's you would see similar trajectory if you went back to 2012 as well. Okay. Yeah. So let's talk about who they are. Oh, you've got another question. Yep.
Right. So these intenders, Sorry, guys, we can't hear the question online.
You want me to replace,
Yes,
repeat the
yes.
question?
That would be even better. I was gonna bring the mic over.
No, I
to
think
you.
that's a great idea. Yeah, sorry. I was just gonna ask that. but
Yeah.
okay.
Thank you.
Thank you.
So how many of these, they sound really good in their pension savings mode? How much of them are planning on using mom and dad? How much of it are
Yeah.
very-
So the question was, how many are gonna use Bank of Mom and Dad? Gifting is a growing percentage of what we're seeing in the overall market. And it's like we kind of planned, like, were you part of my prep for this? Because we're gonna talk about it right now. Yeah.
Good segue.
Good segue. So this slide is not part of the survey work. This I want to set up for you. Who is a typical insured borrower in the Sagen portfolio? And we think this kind of summarizes who the borrower is overall, but we'll show you here how our borrower differs in various regions across the country. So we've got Western Canada, that really would be BC and the Yukon, the territories. The Prairie provinces, Alberta, Saskatchewan, Manitoba, Ontario, which includes the GTA, and then Eastern Canada would be everything else, Quebec and all the Atlantic provinces. The reason that we've broken Eastern Canada in and bundled all those provinces is because that buyer is very similar on all of these metrics. So it made sense just to lump them together. But I think what this shows you is when you hear in the media and for the realtors on the call, you often hear the average home price, and it's going to be well in excess of what you see on this yellow section, the orange section right across the middle of this page. The insured borrower is not buying the average home. They are buying a smaller property. Typically, it's their first time in market. And so our average sale price is much lower than the overall CREA average statistic. So I point that out to you initially. The income needed to service for a first-time home buyer is different across the regions, and that's because of house price, right? So it's not surprising that in Ontario and in BC, where house prices are the highest in the country, you see higher incomes required. Prairie provinces, Eastern Canada, where house prices are lower, there's slightly lower income for our first-time buyers in these segments. GDS ratios, the mortgage agents in the audience will know very well what that is. For real estate agents, you likely do also, but it is a gauge for the affordability metric, how much of somebody's income they're going to be using for the mortgage and interest payments, if you will. The good news is ratios are very in line with what regulations require as maximums, which means that we're putting the right people in the right homes that they can in fact afford. Then you see the gifted down payment component, and we are seeing gifting grow, and we can see that gifting is higher. So we're seeing more applications with gifted as a part of the down payment in the areas of the country that are more expensive. Kind of stands to reason. I'm from Atlantic Canada originally, and gifted down payments are less there than they are anywhere else in the country. And I kind of joke with my parents, I'm like, I'm sure you love me as much as anybody else does in Ontario, but you're just not giving us as much money for a down payment. Really, the rationale is it's not as required when the house prices are generally lower. But I think what you can see here is that gifting is a real part of the insured purchase. A lot of our lending customers are telling us that on conventional loans where someone's got 30-40% down, a big chunk of that is gifted. And what we're seeing, and there's other survey work, it's not in our survey work, but other survey work tells us that there is upwards of $30 trillion of inheritance about to be released in this country over the next decade or so. And a trend that we are seeing is that aging parents are looking to try and share some of that inheritance before they pass, so that they can see their children enjoy it. And much of that is with the assistance of a gift so they can buy a home. So we're expecting that gifting is only going to be a growing part of the home ownership equation going forward. particularly with house prices the way they are and affordability is stretched as it is, support is needed.
A quick question here. Your data for Ontario includes the GTA.
Yeah.
What percentage of detached homes would be in that portfolio for the Greater Toronto?
Yeah, so that's actually a really good question. So the bottom circles that we've not really touched on yet kind of demonstrate we've got obviously a younger segment of borrowers. So at least half of our borrowers are below 35 years old. Credit scores are excellent. So again, they're very well, they've been managing their credit well enough that they're getting ready for this mortgage transaction. And then on the bottom circle, you can see the percentage of our book that is in a detached product. Not surprising that in BC and Ontario, it's a smaller amount than in the other more affordable parts of the country. And to your question, Dennis, if I did this same chart just for the GTA, it's less than 10% of properties in the GTA that are detached in our portfolio for a few reasons. Number one, we have $1 million cap that we need to manage to for mortgage default insurance. And typically a detached property in the GTA, you're not getting for under $1 million. So it kind of wipes it out for the most part. There's certainly some, and so less than 10%, but we have seen a real shift in the GTA of insured borrowers to townhouses and more likely to condos.
Makes a lot of sense.
Yeah. So essentially what all of this means is that the younger borrower is getting squeezed out a little bit. Overall, in every segment of the country, we are seeing house prices go up. So even in the more affordable markets, you're needing more income to qualify. So here's the income column. And so in 2023, you're really seeing more than $100,000 on average being required to service a loan right across the country. And that's more than it was in 2015, which means it's going to be a slightly more affluent borrower. And on the age side of the column, you're seeing that folks in our portfolio that are in the higher age categories is growing, which means that you've got an older first-time borrower needing a little bit more money. So it is pushing some of these younger folks to the sidelines who are intenders, who are anticipating entering the market between 0 to 24. And remember that blue bar, a much bigger segment beyond that. Yeah. This is across Canada. Now, we're seeing in our portfolio probably a third of our applications are with single borrowers. A few years ago, that was high as 40% of applications. So because house prices are growing and affordability is challenged, we are seeing a trend to more people needing to buy with a spouse or even a third or a fourth person on an application. That is a growing trend to try and address these affordability issues. But it certainly is still very powerful to know that, you know, a third of the time, 34% of the time, we are seeing single people buying with, you know, on their own, they're buying. Now, what are they buying? So if we look at first-time buyers and intenders and a breakdown of property type, 2/3 who are buying detached homes are buying with a partner. That makes sense. Mm-hmm. Also makes sense that in the condominium segment, half of people buying condos are single borrowers. So it is meaning, of course, that younger people, single borrowers are buying condominiums, both from an affordability perspective, but also if you're a partner and maybe you've started a family, condo may not be your preferred type at this stage. You know, with the kind of densification of building we're going to be doing, I suspect you will see over time generations of Canadians, like in many other parts of the world, will be raising families in condominiums. So on this, we asked buyers and intenders, what are the most important factors when you're buying a home? What are you looking at? No surprise, prices is a key driver. But what's really important to note is this COVID effect is coming through. And so a big year-over-year change, so I've noted that in the box, is really this notion that people are needing more space in their home to work from home. Also really important to this group of folks that have bought and also people who are looking to buy is energy efficient features, both in the structure of the home itself as well as the appliances that are in the home. So when you're working with these people, particularly agents, when you're showing them homes, these could be the questions that you're being asked. And so as an insurer, if somebody is insured with us and they're buying an energy efficient home, or they are buying a resale home with the intention of raising the energy efficient capability of the home through renovations, they can get a premium rebate through our energy efficient program. And really it's up to 25% of the premium, which is a material amount that they can get back.
Yeah.
All the details are on our website, sagen.ca. Very easy process. The home buyer just completes a one-page application, uploads their EnerGuide certificate or the audit that shows they've increased the energy efficient capability of a home, and then we'll process that within 7 to 10 business days.
That's great. That's actually not insignificant.
It's not insignificant, and so it's important that the homeowners know about it, and increasingly more so now because they are telling us in our survey that it's important to them.
Yeah.
So this notion of space needed at home, we also ask them when they're buying, are they making these compromises between where they want to live and how much money they're going to need to pay? And I think everybody will remember that in the pandemic, there was this rush to move outside the city and chase affordability, and people thought this work from home was going to last forever, so they were moving way out. We've started to see now this return to office. Not completely, but banks started and other organizations, obviously, in every other sector, with maybe 1 day a week, moving to 2 or 3 days a week. I imagine we're going to land somewhere with a hybrid work scenario. But people really are needing to make compromises now, saying, I'm willing to pay more for a smaller place closer to my work, because if you moved way outside to chase affordability, outside the city and close to your work, if you're now being called back to the office 2 or 3 times a week, you're needing to decide to come closer to your office because this commute from 2 hours away isn't doable 3 times a week. So these compromises are being made.
I had a friend moved into Brunswick. I don't think she's coming back to.
She's not coming back. And you know, the reality is, listen, I mean, just in our company, the underwriters that look at these mortgage applications that are submitted and approve them, we were 5 days a week in office before, and then immediately we all had to go home. And then the market exploded for everybody in the lending space and the real estate space. Remember that crazy hairy time in 2021? We started looking to hire people in markets we wouldn't have otherwise. So we're in Oakville. We started hiring people, you know, well beyond in much more rural markets because they were qualified, they had a lot of lending background, and we didn't need them to come to the office. So while we've got a lot of folks returning to office, there are some populations of workers that will not need to. And certainly if we hired you in Sarnia, we're not going to ask you to come into Oakville.
Yep.
But these people that moved out and didn't ask their employers, they might need to come back, depending on their job and what their employment requirements are.
We had a question online about this topic. I'm just going to stand here while I'm nice and close. So Phil asked online, are the first-time intenders actually actively planning to buy, or are they just passively curious about buying in the future?
So they are actively planning to buy. They are in the savings mode. They are adjusting monthly costs down so that they can save more. They are also actively curious. They are more online looking at MLS listings than general population. So they've indicated they are readying themselves for the transaction. So to answer the question, some of them might just be mostly curious and kind of saving, and others who are closer to the transaction are more deeply embedded in the planning process. But they've all indicated to us they're coming in market. Yeah.
Good.
So now let's look at home prices and some mortgage choices. This slide isn't great for someone like me, who is a mortgage default insurer, and in the space of people buying with less than a 20% down payment, because what this shows is over time, and if we look at the bottom line, over time, fewer first-time buyers needed mortgage insurance because they're getting bigger gifts. So we expect that the insured space, we know it is shrinking. So more are buying conventionally. And it's, to your earlier comment, kind of counterintuitive because house prices are going up. So it's taking longer to save a 20% down payment. So why aren't more people buying with 5% down?
Right.
It's because of this gifting phenomenon. It's also because if you get a conventional loan, you can get a 30-year amortization versus 25-year if it's just 5 or 10. So people are trying to find ways to stretch that mortgage payment if they can get to that space. But still almost half of first-time buyers needed mortgage default insurance, but it is a weaning population of new mortgages. First-time intenders, a lot of them weren't quite sure, right? If they're 12 to 24 months away from the transaction, maybe they're not sure how much of a gift they're going to get. So they were unsure if they were going to need high ratio mortgage insurance.
Quick question there.
Yeah.
Insurers like Sagen actually have $1 million cap for properties that you can insure. Is that going to be changing anytime soon, and with housing prices and all these things that are happening? Do you see that changing?
Yeah, so it's a great question, and the answer is no,
Okay.
not anytime soon. We certainly lobby Department of Finance, our regulator, OSFI, about the importance of lifting of the cap. Maybe not removal of it entirely,
No.
but indexing it and raising it. Many years ago, we used to be able to insure over $1 million, and that was changed by way of regulation in 2012. Well, in 2012, there were very few homes over $1 million.
Right.
So it was an immaterial regulatory change, didn't change much in our portfolio. Today, and in Ontario, I recall, I think June or July of last year, 40 some odd % of every house in all of Ontario was over $1 million that was sold that month.
Mm-hmm.
So it is much more a normalized home price.
Right.
The regulator and Department of Finance continue to struggle with thinking that $1 million property is a first-time home buyer's property. But our survey work and our portfolio work, and I showed you some of that, demonstrates people are buying with ratios really in line. We see default rates at all-time lows, and it's because they're managing the mortgage payments really, really well. And there's a lot of people that could handle a mortgage of that size, but if they're not in a family that's giving them a gift, they're sidelined until they can save enough money over $200,000 if you need to save a 20% down payment on $1 million home. So we're showing them that there is a population of borrower that can manage that payment. They just need to get in market with a lower down payment than 20%. I think we've really gotten to a point where the regulators recognize that they get it. They're going to need to raise the cap. They just aren't interested in doing anything right now that will stoke demand, is the message that we're hearing. So we continue to advocate for that. On this slide, we did ask the question of those recent buyers, as well as intenders who thought they were going to buy a house over $750,000. If the option of a 30-year AM was available, would they want to take advantage? And the majority of them said yes. So we continue to advocate for a 30-year amortization as well. And today, insured mortgages are less than 20% of every mortgage done in Canada is a mortgage default insured loan. And so that means 80% of the time people can take 30-year AM. Okay. But these first-time home buyers can't if they're buying with 5 to 20% down. We continue to suggest that they're a responsible bunch and that this offer should be extended to them as well. And the reality is, if you think about it, they're younger, they've got lots more earning income ahead of them. And I'd rather personally give a 30-year AM to someone who's 35 than I would someone who's 65. But the reality is it continues to be unavailable in the insured space. So we continue to talk about responsible home ownership and why we do think this would be a prudent way to try and help with affordability. Yeah. We saw a lot, and we've talked about gifting, but a lot of people saying they need some financial support, whether it's through a lump sum down payment, whether it's repayable or gifted. We had some people say they actually need help with their monthly mortgage payments. Now, if you're a mortgage agent and if you're a lender, you know that we don't factor in help from mom and dad on a monthly mortgage payment. You've got to, with your income, qualify to cover your mortgage. And Veronica tells us that what's really coming through in this question is that people need help with their overall monthly obligations from mom and dad, which might mean maybe they need help with daycare costs or activities payment or what have you. But it's definitely showing that there is this growing increase in need for gift. But again, a full 40% said, no, I didn't need a gift at all. I didn't need anything. A lot of intenders on the other side in green aren't sure if they're going to need a gift. Fewer of them think they're going to get a gift at the top than first-time buyers that actually did receive a gift from mom and dad. But certainly what's coming through is that affordability pressure is saying that people need some kind of help financially.
Both of my nieces tried to go to the bank at M&D, it didn't work out.
Didn't work out. No, it doesn't always.
Doesn't always work out.
Right. What's interesting is some of them didn't know whether it was a gift or whether it was a lump sum, like payment that needed to be repaid.
Right.
So mom and dad gave them the money and perhaps weren't clear on whether it was repayable or not. I imagine they'll sort that out long term. This we think is an important piece of information, particularly, well, for both groups that are here. Mortgage agents, you need to understand how influential your realtor partners are in mortgage information. So the question here is to this group, where did you go to get mortgage information? A lot of them went to mortgage brokers, mortgage specialists, family and friends, but look at how high realtors are. And this underscores why at Sagen we have a real estate strategy. We believe it's very important that we inform agents a bit about this mortgage process so that A, they come to you as better informed referral sources, but because people are asking agents mortgage questions. So they should have a degree of knowledge to have an informed conversation. We always encourage you to point them then to a mortgage professional that can help them with more of the details around mortgages. But it is a growing part, and year over year, more people are saying they're asking their real estate agent about mortgage information. So it's important to solidify your relationships so that you're really working in collaboration to help these people with all of their real estate right through to mortgage needs. Growing from builders and developers and financial planners. And Veronica has suggested that why financial planners at such a growing rate? It could be because as house prices grow, so do down payment needs, and a much bigger down payment might need some financial planning to get there. So there's a lot of sources of where people are going to look for mortgage information. Here's other areas, mobile tools, etc., social media. What we would suggest to you is they're falling back at the end on people, mortgage specialists, mortgage brokers, family and friends. So they're getting all this information and then they're coming to you for advice to unmuddy it all and make sense of it all. So the good news is in this transaction, people still need advice, which is really good sort of job security for people who are advice givers in this space.
Do you have that slide on where they're finding advice on quality search? This is basically
Yeah, it's a great question. So it's where do they find their information on home search? We didn't ask that question, but the reality is based on a lot of these mobile tools and internet, we do know from my time in the real estate space that a lot of it is realtor.ca, but that some of the big real estate brands are getting heavy traffic as well, of course, for looking for properties themselves. There's a whole host of tools, but we didn't ask the question in this particular survey work. So at Sagen, we don't talk to the first-time home buyer directly. That is you guys or the lender, and create a lot of collateral material, articles, website content, blog content about the first-time home buyer, and it's speaking directly to the first-time home buyer. We want you to use it in your communication strategies. So on sagen.ca, you will find a whole host of pieces of information that you can leverage in your own blogging, social, and communication strategies. And we really hope that you look at it. If you're comfortable with it, feel free to use it in your communication pieces. If you don't follow us already on LinkedIn, please scan the QR code. I'd recommend that you do. That way you'll be able to see when we're talking about something new, when we've released new data, that you can obviously incorporate in what you're sharing with your prospective clients. Twice a year, we do a mini digest. It's like a mini magazine, lots of articles for the first-time home buyer and move-up buyer around the moving process, the search process. Some of these survey results are highlighted there. You can find it digitally at sagen.ca. Flip it to your borrowers. I know you're always looking at how do I stay sticky and in touch with my customer from application to approval to funding to closing. These are good things to share with them along the way so that you're staying top of mind.
You're typically updating your research in the spring. Is that what you're doing? Like
Every year we update it in the spring. So that's when the survey work comes out. This we release in the spring for spring, summer, and the fall winter digest will be out probably mid-October. So come to the site, look for it then. We've also just recently launched podcasts. So this is going to be about an hour session. You can often, if you're finding yourself with 10, 15 minutes of extra time, you're in the car somewhere, we've got a podcast series now that you can just find one. There's dozens of topics. Maybe it's on purchase plus improvement. Maybe it's on our new to Canada product, 5-7 minutes long, and you can learn with us along the way in a podcast.
We'll add
format.
these links to the follow-up email as well, so you guys have all that.
Great. Here's a lot of the ways that people can buy with a low down payment. This isn't an exhaustive list, but this is what some of the podcasts are going to be about. Along with, there'll be a podcast on the energy efficiency program that we talked about as well. But there's lots of ways people can buy with a low down payment. Now let's just tie it all together and wrap it up because I am mindful of time. We've got a bit more time, but really the story is the market is tight. People are feeling stretched, but there is still some confidence in the market and they're coming back. But there definitely, while we were in market, there's still some economic uncertainty. And the reality is inflation rates were released last week and they're not as low as people wanted. So there is now this renewed talk. Will there be another rate increase? Will there not? There continues to be some economic uncertainty. The profile of the first-time buyer, they are older. There's a little bit more money required. So they're more affluent, a first-time buyer than they were 5-7 years ago, for sure. This proximity to work, they're trying to find this balance between I need space at home to work, but I'm going to get a smaller spot closer to the office. So if I was a builder or a realtor, I don't envy you because people are saying, I need to be close to the office. I need to find a place that's got a place for us to live, this many bedrooms and an office so that I can work and I don't want to pay too much money. And they're balancing all of these things. But that's why you're professionals, right? Face these challenges, but that's certainly what's coming out in the survey work. This back to work requirement. We know that down payments are surging faster among these first-time buyers. Home prices are growing. We talked about gifting and these affordability support needs, and that 6 out of 10 first-time buyers and intenders are saying, yeah, I need help of some kind, for sure. There were some financial fitness declines in this first-time buyer segment. There's this anxiety about, can I meet my monthly obligations? But we heard from TransUnion last week, and we're not seeing early cracks in ability to repay. So that's very, very positive.
That's very possible.
For sure.
Yeah.
So it is more anxious about what might happen than what actually is happening. But then at the end of the day, while they're feeling stretched, there really is long-term optimism and confidence in the market. And, you know, as tight as affordability is now, people are still wanting to buy, and we've got lots of immigration that will be coming to this country, and these folks are going to need a place to live. And so good news for our markets. We're just feeling a little bit of a pause-ish period, if you will, right now. But they're readying themselves to come at you.
Awesome.
Yeah.
Any other questions in the room, or Mel, any questions online? I have to.
The answer, I see the head shake. There's no questions online. So it was clear as mud. I answered most questions, or it's so confusing, people don't know where to start. I don't know which it is. So we didn't break it out specifically, but a lot of what survey work shows is that often when new immigrants come to the country, they rent for a period of time. When they do buy, though, they have a higher rate of home ownership than people who were born in Canada. So immigrants definitely, and the overall home ownership rate, by the way, is like 67-68% in Canada. So immigrants, once they're here and they establish themselves, they really view that as an important way of establishing themselves in Canada, is to own a home.
Okay.
And so their home ownership rate is higher than 68 or 67%. Yes.
Oh, right.
Oh, my name is unusual one. Is it the one? I know that Sagen put it all
So it's not. So the question was, what we're printing, does it have the capability to brand it yourself, put your name on it? No, we had that tool and we wound it down because it really wasn't being utilized at all. So I love that you've asked the question, but you would have been one of few people who actually did the branding of it. But the digital digest is absolutely available, and you can share the link with any of your prospects, your recent buyers, anybody in your contact list. Yeah. And over here.
2 questions.
Okay.
Do you know after how many years an immigrant has been in Canada that they started really thinking about buying? How many years at this point, perhaps?
So I'm gonna guess, because it's not in our survey work, but last I heard, home ownership rates really spike after 5 years of being in the country. Some of them will buy sooner than that. If they're buying on their own, it's probably delayed, but some new immigrants will buy intergenerationally, and when you pool income like that, they're buying sooner. But that is not in our survey work. That's my remembrance of recent other sessions I've been part of.
Second question is, I feel like I know the answer to this, but are you changing your guidelines to allow extension of amortization on renewal without, like, are you allowed?
So the question is, are we allowed to extend amortization on renewal? The answer is no. However, we can use extended amortization as a tool if a borrower is having a challenge meeting their monthly obligations on renewal because their rate has gone up so much on renewal. So lenders do have the capability to extend amortization to support people who really need some financial assistance. So that's not just for everybody, but if you really demonstrate that I'm now renewing my mortgage and the rate's gone up so much, I absolutely cannot afford it. We do have the ability to extend amortization then, but not otherwise. So lenders have those details. We'll work with the lender to try and determine someone's financial state. But the good news is we're not seeing that tool leveraged very much, even though there are people in adjustable rate mortgages and in variable rate mortgages that maybe now they're having to renew at much higher rates. The stress test, as much as folks didn't love it, buffered, it helped. There's a full 2-point buffer in there. But also over time, people's incomes have risen. And so that has also helped bridge that gap a little bit with some affordability. And there's embedded equity in that property, and they're looking for ways to do anything to save defaulting on their property before they're going to not be able to. But we do have that tool in our toolbox to help in need. It actually raises a great opportunity for me to advertise something that I'm actually most proud of in our business. And that is this ability to help people who are struggling. And so on renewal would be one of them. But, you know, we all work real hard to get people into home ownership. And as a mortgage default insurer, we're there to pay the bank if someone defaults. But nobody wants somebody to default on their mortgage. That means taking them out of their home, and that's awful.
Yeah.
And so I'm really, really proud that we have really pioneered this ability. If someone gets in trouble, maybe there's been an illness and they can't work for a period of time, or they've lost their job, or they've lost variable income, their part-time job, or there's a marital split. There's a short-term inability to pay their mortgage. We can work with them to try and find a way for a short period of time to keep them in the home while they get back on their feet. And that has been done close to 60,000 times. We have done that to keep people in their home, and almost all of the time they never default on their mortgage, which means that if you give someone a bit of time, they'll get back on their feet. I joke that it's not for somebody who went to Casino Rama and they blew all their money and they now can't pay their mortgage. This is for people who a life event has happened and they're struggling, but they're going to get back on their feet.
Yeah, I have one more question online if you have a moment to take it. Online, are temporary residents who are first-time home buyers able to, or are they allowed to purchase a home without paying that NRST tax?
I don't know.
Okay.
I'm not going to answer the question related to NRST tax. So I'm going to leave that to another expert, but we do have a program where those that are new to Canada are able to buy with as little as 5% down. So if you've not yet established credit in this country, and the way that we give mortgages in this country, often your credit worthiness is a related part of that. And so lenders lean on your credit bureau score. If you don't have a credit bureau score in this country, we will look at, for these newcomers, what has your rent payments been like, et cetera, in the last 12 months or so. And then we can allow them with good repayment capability to buy with 5 or 10% down. And again, as mortgage agents, you will know those details, or details are on our website. But certainly that enables folks to get in with a low down payment.
Yeah, and just for whoever posted that online, it was an anonymous question, so a real estate lawyer would be a good avenue to answer that question. If you're a realtor joining and you were invited by one of your Pineapple agents, feel free to reach out to them. We've got quite a few connections with different real estate lawyers, so we can get you in contact with somebody. And I think Marlon, yeah.
Just to follow up on that, also, is there any exception made to that?
Yeah, so the question, if you didn't hear it, is there ever an exception made to the 12 months? And the answer is yes. There's kind of an exception available for almost anything. What we want to try and do is holistically underwrite that loan. So look at that borrower and try and figure out, if they're a little weaker here, is there strength in another area of the application? Now, with a newcomer to Canada, if they don't have a lot of longevity by way of job tenure, et cetera, we do want to see that 12 months of rent repayment, but not to say that there's never an exception made. There often is, but we want to see real strength in marketability of the property, job tenure, other things that balance out shorter credit worthiness, if you will.
Any further questions? We really appreciate your time today, Kiki. It was wonderful having you here. And if there's any other questions, like afterwards, send them to me and I can get through to Kiki.
Yeah. Listen, this was a really engaged group. There were lots of questions. Sometimes we'll do this and there aren't many. So I appreciate that because it means you're listening and you think it's interesting. Anyway, Pineapple, thank you for having me. It's such a pleasure to work with all of you in the market. And between all of us, we're finding ways to get folks into homes. And so I think we play an important role in keeping the economy going and helping people on this ladder of financial wellness. So
thank you very much.
Glad to
Thank
be a
you to
part of
everyone in the room and thank you to everyone who. Have a great day.
thanks.
Thank you. Thanks, everyone.
Mhm.